when a market lost its mind. It started with a single price move that made no sense. Traders stared at their screens, confused and amused, then uneasy as the pattern repeated again and again. Something irrational was spreading, fast. This story matters now because modern markets move at lightning speed. Algorithms react in microseconds. News travels instantly. A rumor can shift billions. And yet, even with all our data and tools, markets can still behave like living creatures driven by emotion rather than logic. To understand how quickly reason can dissolve, we need to revisit the day when rational pricing simply stopped working. It began quietly. A few stocks drifted upward without clear explanation. Analysts shrugged. Retail traders celebrated. Funds adjusted their models to account for the odd behavior, assuming it was temporary. But the moves continued, growing stronger, stranger, harder to fit into any recognized pattern. Momentum overshadowed fundamentals. Sentiment overtook strategy. Behind the scenes, a new wave of traders emerged. Individuals who didn't care about valuations, earnings, or balance sheets. They cared about movement, hype, and the thrill of collective action. Forums buzzed with energy. Social media turned tickers into battle cries. A stock wasn't just a stock anymore. It was a symbol of rebellion, unity, and the belief that ordinary people could force the market to bend. Institutional investors watched with skepticism. Their models flagged anomalies. Their risk systems blinked warnings. But the rising prices didn't stop. Underdog companies soared to heights nobody predicted. The narrative was intoxicating. The small investor against the giants, momentum against logic, hope against arithmetic. But beneath the euphoria, pressure was building. Short sellers faced mounting losses. Funds scrambled to cover positions. The cost of borrowing shares skyrocketed. The more the market defied gravity, the more tension accumulated. A feedback loop formed, one that few understood, and even fewer could control. The early reveal was unavoidable. The market was no longer evaluating businesses. It was reacting to emotion, pressure, and spectacle. The numbers on the screens were beginning to detach from reality, and all it took was one final spark for everything to accelerate past the point of reason. Momentum kept building, fueled by voices that grew louder with every uptick. Online communities celebrated each surge as proof that they were finally in control. Memes became market signals. Screenshots of sudden profits spread like wildfire, drawing in new waves of traders who cared less about risk and more about belonging to something electrifying. But beneath the enthusiasm, cracks began to show. Volatility spiked. Bid-ask spreads widened. Some platforms struggled under the weight of unprecedented trading volume. Veterans in the market sensed instability. They had seen manias before, though never one amplified by millions acting in sync across digital networks. They warned that the rally couldn't last. Their caution was met with mockery. Meanwhile, short sellers were drowning. Losses mounted at speeds that left seasoned professionals stunned. Funds that placed calculated bets against failing companies suddenly found themselves on the defensive. They rushed to buy back shares, not because they believed in the companies, but because they were being squeezed out by relentless upward pressure. This panic buying only fueled the surge further, creating a spiral that no model had prepared for. The reveal intensified as major financial institutions scrambled to rebalance risk. Trading desks questioned whether their systems were malfunctioning. Analysts tore apart data sets looking for explanations, but none of the usual metrics mattered. Earnings reports were irrelevant. Balance sheets were ignored. Prices behaved like a tide pulled by forces nobody could fully see. And then came the first wave of restrictions. Trading platforms quietly limited certain types of orders. Margin requirements increased. Borrowing costs soared. These changes were small at first, barely noticeable to the most enthusiastic traders, but they were signals of growing concern behind the curtain. Institutions were trying to contain the frenzy without admitting they were losing control. Retail traders saw the changes as proof of their power. They believed the system feared them. The narrative intensified. The movement grew. But with each new burst of optimism, the market grew more distorted. Some stocks swung wildly within minutes, gaining or losing billions in value based on fragments of rumors or viral posts. The early conflict emerged in full, a market caught between logic and fervor, between institutions defending stability and a swarm of individuals determined to rewrite the rules. Price and value drifted further apart, stretching into a gap so wide that something, somewhere, would eventually have to snap. The snap came with a swiftness that stunned even the most seasoned traders. One morning, before the market opened, a major trading platform announced it was restricting purchases on several of the most volatile stocks. No warning, no negotiation, just a single message that froze the movement in its tracks. Within seconds, panic replaced euphoria. Prices that had soared for weeks now plunged in minutes. With buying throttled, the upward spiral reversed direction. Retail traders who had once felt invincible watched as their screens filled with red. Forums exploded with anger, confusion, and disbelief. Accusations spread like sparks in dry grass. Manipulation, sabotage, interference. The movement that had united millions now fractured under the weight of betrayal. Institutional players were caught off guard too. Forced sellers scrambled to unwind positions. Market makers widened spreads to survive the turbulence. Risk managers issued emergency alerts across trading floors. The same frenzy that had inflated prices was now dragging them downward with equal ferocity. Models recalculated endlessly, yet none could stabilize the chaos. The conflict reached deeper when long-term investors began reassessing their exposure. They realized the distortion extended far beyond a handful of stocks. Derivatives tied to volatility spiked unpredictably. Funds that relied on stable markets saw their strategies torn apart. Even sectors unrelated to the mania experienced wild swings as correlations broke and capital shifted between assets at dizzying speed. Behind the scenes, regulators convened emergency meetings. They debated how much intervention was necessary, how much was fair, and how much would worsen the fracture in public trust. Every decision carried consequences. Restrict too little, and the chaos might spiral. Restrict too much, and confidence in the market's fairness could shatter permanently. Meanwhile, retail traders faced a psychological war they hadn't prepared for. Some doubled down, convinced the dip was temporary. Others sold in fear, locking in losses they had never imagined. The emotional arc swung violently. Excitement to anxiety, unity to division, triumph to confusion. Many realized too late that they had never been fighting institutions alone. They had been fighting the structure of the market itself. As prices continued to tumble, the atmosphere grew heavier. What once felt like a revolution now felt like a reckoning. Screens that had been symbols of empowerment became windows into a storm spiraling out of control. Traders refreshed apps obsessively, hoping for a miracle bounce that never came. This was a full conflict. A market pushed beyond reason, then yanked back toward gravity with terrifying force. The gap between value and price, once a playground, had become a battlefield. And at its center were millions of people discovering just how unforgiving a market becomes when it finally snaps back to reality. When the storm finally settled, the market looked like a landscape after a wildfire. Prices had scorched downward, leaving behind the charred remnants of once celebrated gains. The momentum that had carried so many upward now revealed how fragile those victories truly were. The climax hit in a moment of brutal clarity. The frenzy had not been a revolution. It had been a mirror, a reflection of how emotion, community, and the illusion of control can override reason. Traders who once felt unstoppable now sat stunned, staring at losses they never imagined. Institutions that believed they could contain the mania realized how quickly markets can slip out of conventional boundaries. Even regulators, armed with rules and authority, found themselves reacting rather than directing. But in the quiet that followed, a deeper truth emerged. Markets don't lose their minds. They reveal ours. Every surge, every crash, every irrational swing begins with human behavior amplified through technology. Fear becomes contagion. Hope becomes fuel. Confidence becomes fragility. And once those emotions reach a critical mass, even the most sophisticated systems can be overwhelmed. The resolution came slowly as traders and investors began piecing together the lessons. Fundamentals still matter. Risk still matters. The crowd can lift you higher than logic allows, but it can also drop you just as fast. Some participants walked away hardened. Others walked away wiser. Many walked away determined never to mistake noise for knowledge again. And yet, the story carried a modern relevance that couldn't be ignored. In a world where communities form instantly and information spreads without friction, the boundary between investment and momentum can blur in a heartbeat. The next frenzy may take a different form, but the forces behind it will be the same: emotion, connection, and the timeless habit of chasing what rises. So what do you think? Are we repeating the same mistake again?